Welcome to the Daily Update Podcast, where I'll go over the action in the market for Friday, September 12th, and we'll see how things look for Monday, September 15th. Going over the market's performance on Friday, it was a quiet, low-conviction session across the board. The S&P 500 closed virtually unchanged, dipping just 0.05% on above-average volume. A volume spike that at least suggests some underlying interest, even if conviction felt muted. Prices opened flat, meandered around the unchanged line throughout the day, touched intraday resistance at 6,600, and then eased back ever so slightly. We can contrast that with the NASDAQ and NASDAQ 100, which bucked the trend and etched new all-time highs. This was largely propelled by strength in mega-cap tech stocks, including Apple and Tesla. These heavyweights more than offset broader market weaknesses, with supportive performances from utilities and discretionary. On the flip side, small and mid-cap stocks lagged, and within large caps, growth stocks continue to outpace value stocks, underscoring the ongoing rotation towards high flyers. Looking at our key indicators, the trends remain broadly positive across the short, intermediate, and long-term timeframes. Short-term conviction is in fact strengthening by seeing the StochRSI, Williams percent R, CCI charts, and stochastics all giving extreme readings. However, we must temper enthusiasm with caution. There is also extremes in the short-term RSI chart, and the S&P 500 is far away from its 20-period moving average. On the intermediate term front, we're still riding a positive trend, and we're in the +3 channel with the standard deviations chart, which has been remarkably resilient. But long term, we're positive, but always aware of some vulnerability. The S&P 500 is trading more than 10% above its 200-day simple moving average, a level that has historically preceded pullbacks. We'll keep watching that if it continues to climb higher above the 10% level. Volume and breadth paint a more nuanced picture. The above-average volume is encouraging, a vote of confidence in the uptrend, yet breadth was decidedly mixed. The advanced decline lines are rather sleepy on Friday and even veering more negative. New highs are flattening out, and the chicken money flow is turning negative. The NYSE McClellan oscillator is positive, but did show some weakness, while the S&P 500 McClellan oscillator has now turned negative. Looking at sentiment and volatility, it's neutral overall, even though the S&P is setting new all-time highs. The VIX is still well below 20, and the equity put-call ratio is declining, while the high beta to low beta ratio and risk-on versus risk-off ratios continue to show strength. That said, consumer sentiment did take a bit of a hit, dropping to 55.4 against expectations of a reading of 59.2. Looking at sectors and ratios, there's continued improvement with the growth of value measurements that we look at, with large cap growth leading the charge. Mid caps and small caps are starting to lag behind. The discretionary to staples ratio is positive, and semiconductors are trying to break out to make new highs, a bright spot for tech. The financials, however, continue to underperform the S&P. While the declining staples to tech ratio, as well as staples to S&P 500, are seen as positive. Looking at the economic context, interest rates did edge higher, with the 10-year yield climbing to 4.06% from 4.01%, but still well below the 4.5% level we've been concerned with. And the dollar did strengthen, but still remains in a downtrend. Gold continues to break out, while readings from the latest M2 money supply growth raises flags about potential inflationary pressures down the road. Corporate confidence remains high as the announcement of buybacks continues to be elevated. This is a positive signal, though execution isn't always guaranteed. Profit margins are steadily improving, steering clear of recessionary depths. And our bull market is approaching its third birthday, aligning with the duration of prior cycles. Historically, government shutdowns, though having short-term drama, have proven positive for stocks in the aftermath, where we see short-term turbulence but longer-term resilience. Concerning valuations, U.S. stocks look stretched relative to global peers, with earnings growth widening as the Magnificent Seven continue to dominate. Looking ahead to the upcoming week of September 15th through the 19th, anticipation is building around the Fed's Wednesday decision at 2 p.m. Eastern Time. The markets have priced in a rate cut based on rumors, but remember the old adage, buy the rumor, sell the news. Key data releases include Monday's Empire State Manufacturing Survey, Tuesday's retail sales and industrial production as well as capacity utilization figures, and Thursday's initial and continuing jobless claims. There are no major reports due out on Friday. Seasonality offers a neutral to positive tilt early in the week, but mid to late September has historically been weak, the worst half-month period going back to 1950. We're also entering options expiration week, which could provide a slight positive nudge, and geopolitics appears to have no direct bearing, at least at this time. In conclusion, the outlook carries a positive bias. Short and intermediate term momentum is improving, while long-term trends are remaining healthy. The 6,600 level is now acting as overhead resistance. Keep an eye on potential pullbacks towards the 20 period and especially 50 period moving averages. Vulnerabilities intensify if we stray further above the 10% level with the 200-day simple moving average. Broader internals, including the parabolic SAR, vortex, and momentum oscillators, are improving, though mixed breadth and sentiment extremes call for vigilance. Overall, if we see a decline, this suggests this is more about healthy profit taking than a major reversal, though we will evaluate if that starts to occur. Thank you very much, and I will talk to you in the next podcast.